All right, go ahead, Ken. Unless you want me to start.
No, I will do it. Good
Go
evening.
ahead.
We're just stepping all over each other tonight. Okay, here we go. Good evening, everybody, and welcome to the March 28th session of the Roundtable. This is Ken Kavula from the Mid-Michigan chapter of Better Investing, and I'm joined this evening by some of my best investing friends in the country here, Mark Robertson, and Mark is experiencing some technical sound difficulties, so if we lose him occasionally, everybody help by telling me that you can't hear him if that happens. Lynch is with us tonight. Is the chairman of the NAIC board, and I've known for 20 years or so, and he and I have volunteered at innumerable sessions. He's certainly a great stock picker and a wonderful person to listen to about the philosophy of investing. We have one of our most successful women investors with us this evening. We call them damsels, and this is Ann Manning. Ann was our very first damsel back about 12 or 13 years ago, and she's asked us to come back and present a stock tonight, and we're always happy to hear from Ann and whatever she's going to recommend. We have Hugh McManus with us. Hugh is the former chair of the Volunteer Advisory Board for Better Investing, and he's been with us for since the inception of this group. We've had him off and on the last couple of months. His job has really kept him busy, but we're so happy that he's with us this evening. And Mark, I think I've dithered enough. Let's go into the
Good.
the disclosure there real quickly and talk about it so we can get that out of the way.
You know, that said, I'll bet Lynch doesn't mean Jimmy Stewart. Go ahead.
This is an educational demonstration. We are going to talk about real stocks in real time. We'll let you know if we own any of those stocks in our portfolios. We'll do everything in our power to remind you of our ownership. But we're not here to make stock recommendations. We're here to give you ideas so that you can go home and study those ideas and decide for yourself whether the particular stock we're talking about is a buy, a sell, or a hold. You might disagree with us 100%, and we might think it's a buy, and you might think it's a hold, and there's room for both of us in the Better Investing tent. That's what Better Investing is all about. If you'd like to be reminded about these roundtable sessions, which happen once a month on the last Tuesday of the month, drop a note to my wife at nkavula1@comcast.net. That goes for any of your children or grandchildren or other relatives. It goes for friends, neighbors, or anybody else you come across that might be interested in listening to a little bit of straight talk about investing. If you'd like copies of these slides, we do post them on our YouTube channel, and you can also get a complete copy by dropping a note to Mark R. at manifestinvesting.com. So with that, let's move on to our next slide, Mark. Our agenda sits pretty steady, and it has since we've been doing this. We started this whole process about 13 years ago when four of us sat down. I told Mark no costumes, no funny gear, and if that was going to be the rule, then I would participate. I don't know how he talked Cy and Hugh into doing it, but he talked four of us into making this work, and we're still doing it 13 years later. We're real pleased with the results we've been getting. We're going to do a little bit of refreshing about a couple of things, the triple play. We're going to look at our performance results. We have some stocks that might or might not be on the hot seat. We're going to have 5 stock presentations this evening, and we'll give you a chance to vote on which one you think is the best stock idea for an extra $1,000 addition to the roundtable portfolio. This is not real money, folks. It's all imaginary. It's all for sport, and we hope that you view it in the spirit that we're doing it with. Nobody gets angry at each other. It just happens, and we have a pretty decent results. We started by saying we'd like to end up beating the market by 5 points, and we gave that beat a name. We called it relative return. The relative return is the difference from what you could get by investing in the market and what you are getting by investing in whatever it is you're investing in. We wanted a positive 5% or better long-term relative return. We were going to use the Wilshire 5000 as our benchmark. That's an index that has 5,000 of the most widely traded stocks in the country listed. So it does a pretty good job of representing small, medium, and large size companies. We'd like to limit our non-core holdings. Remember, core is basically up, straight, and parallel. And we'd like to limit our non-core holdings to maybe 25% or less of the total positions. And we'd like to beat on about 60% of our choices. We'd like to beat the market, not necessarily by 5, but we'd like to beat the market on at least 60% of our holdings. We share the results with you every roundtable, and here are our results as of, I guess it's as of yesterday, right, Mark?
It's actually probably sometime today, but I'd actually have a footnote. We're going to change the 60% to 55% based on the Tillinghast book that we'll be reviewing in 2 weeks at Bull Session. Because 55% is a pretty good number to shoot for. And anyhow, that's just a footnote.
Okay.
Here's our results.
Thank you in the audience that are telling me that Mark's audio is a little bit muddy. It sounds muddy to us in the back room as well. So you don't have to write me any more notes about that now, but there's not much we can do. We're lucky to have him so that you can at least hear him tonight. We spent a long time trying to get sound to work and weren't very successful at that. Here's our results, folks. This goes back about 13 years. The graph itself starts at about our 3rd year, only because we had to chop it somewhere. It's the length of time is getting pretty long. But here's 10 years of our results. That dotted red line is beating the market by at least 5 points. And that's beating the average by 5 points, because the average return over all these years has been around 10%. So that dotted red line represents 5 points of relative return. We beat the market by 5. Our return right now is 14.8%. That's a pretty decent return for a long-term portfolio. The mirroring investments, the Wilshire 5000, is registering a gain of 9.1% annualized right at the moment. So you take 14.8, you subtract 9.1, and you get 5.7. That's our relative return, and it's higher than 5, which was our goal. You can see that the first time we hit our goal was somewhere around the first or second month of our 7th year. And except for a brief time in our 11th year, we've stayed pretty much at or above that goal. It's not an easy thing to do, and we're kind of proud of what's going on. Our outperformance accuracy is about 51%, 50.6%. You can see it at the bottom of the chart right down there. That means that 51% of the companies that we've chosen have beat the market, not necessarily by 5 points, but they've beat. We're in the process in our bull sessions, which are held at 2 o'clock every single Tuesday of the year. If you're interested, drop me an email, drop Mark an email, and we'll be sure to give you information on how to attend one of our bull sessions. Our bull sessions are getting involved in a book report in 2 weeks. And one of the gentlemen that we're reading has suggested that Even the very best stock pickers don't pick stocks at 60% plus. They pick stocks at 50% plus. And I think that's the reason for Mark's suggested footnote that we change our 60 to 55%. Am I kind of guessing correctly, Mark?
You got it. Am I less muddy when I do it like this?
Yeah, that's better. Whatever you did is better. Uh-huh. So
I'm,
let's go
I'm
one
standing
more.
standing on my head.
Standing on your head. Okay, let's go one more slide. Here's a listing of the top holdings in our tracking portfolio. Folks, a tracking portfolio is very different from a portfolio that you might put together for a stock club. A tracking portfolio lists every single stock that you've mentioned over a period of time that you've chosen to place in the portfolio. It contains many, many more stocks. And the idea is as you come up with your best ideas, you place the best of the best in the portfolio. And then you see what happens. You track it for a reasonable period of time. How often have we put in different sets of $1,000? Well, if you look at that upper left-hand corner, you'll see our legend. That 15X means that Cognizant has had 15 $1,000 infusions of cash. 12X means that Google or Alphabet has had 12 infusions of cash. 11 of X Booking has had 11 infusions, and you can follow that all the way down. Mark's baby, Ardelyx, has had 10 infusions of cash. You can see our best holding right now, our largest holding is Microsoft, and that's the result of only 5 infusions. We've put $5,000 at various times into Microsoft, and it's resulted in $70,000 plus. We've had some very interesting discussions about that, and some very interesting facts have come out of this Microsoft holding, but we won't go there this evening. If you don't see a stock in the legend, that means it's only been chosen once. And I think there's a representative of the One Club down there in Costco, if I'm not mistaken. I think that Costco holding of $10,000 represents only a single choice quite a while ago, a reasonable amount of time ago. But that's certainly been
Yeah, that would be
Go on, Mark.
Hugh McManus back in 2010.
In 2010. So, my goodness, 2010, 13 years ago, almost at the beginning of when we started this. So
And
you can find
can I
this whole.
also, I was just going to say, can I also give credit where it's due? Ardelyx is only an adopted child in my family. It's an original child of Hugh McManus.
Absolutely. We don't have time to discuss only Ardelyx tonight in the roundtable, but Mark's going to want to bring us back there all the time, because at the moment it's giving him fantastic returns in almost any portfolio he's put it into.
You betcha, baby.
You betcha, baby. Let's go. let's let's look at that. Before you leave, Mark, there's a URL. If you want to see the entire portfolio, then that URL in the upper corner up here will take you to the entire portfolio. It's free. It doesn't cost you a penny, and you can go in there and take a look at all the stocks we've put in the portfolio over the years. It does not include the stocks that we've sold from the portfolio. So it's only the active stocks, and we do some selling. Witness our next slide. Let's go to the next slide, Mark. We like to challenge stocks, and we like to challenge them at both ends of the spectrum. We like to look at stocks that might have par values that place them in a position where we can do better with cash. And right now, Regeneron, LGI Homes, and NVIDIA, we might be doing better if we were to put that cash into some kind of a money market. There are now money markets that are beginning to pay 4.5%, 5%. So we might take a look at that. That does represent almost 6% of the portfolio. If you look at the percentage of total, you'll see those three additions come to 6%. And you'll notice that the growth, which we keep a real close eye on in this portfolio, the growth for NVIDIA is still exceptional, the anticipated growth, but the growth for Regeneron especially is moving down to a growth rate that might ask us, why are we still holding the stock? We've made some nice money in it. Maybe it's time to move it out of the portfolio. As you might expect, the stocks at the bottom with the biggest losses right now all belong to the banking sector. And we don't get real fancy with banks. We've looked at two banks in this portfolio over the 13 years. And one of them is Western Alliance Bank, and one of them is First Foundation Bank. To be honest, I'm feeling extremely good right now, at least, about Western Alliance as it moves forward. And I'm feeling very good about First Foundation. I think Western Alliance appears to have a few stronger numbers than First Foundation, basically because of the size of the two banks. Western Alliance is quite a bit larger than First Foundation, but I'm of the opinion, and I'd like to hear from the rest of the folks on the panel, I'm of the opinion that it's not the time right now to sell at the bottom of this. It seems like a panic, and I don't like selling during a panic as it's happening. I think the people on TV right now, they're just as excited as our weathermen get when we might be having 9 or 10 inches of snow. They're dancing all around, and they're warning us about things that good common sense would tell you that you knew about already. So what do the rest of you think about the banks?
I love them. This is Hugh.
Yeah, I see no reason to worry about these banks or any of the banks in our portfolio. And I just notice all of those. There's a First Foundations. It goes back 2 years, 223. It looks like of 21 that Ken picked it first, and then there's a couple other 21s, but most of those have been bought within the last several months, and banks have been hammered in the last 3 weeks.
Yeah.
And the market has, done what it has done in the last year or period. And so it's the new banks, the banks that have been around for a little bit longer in the portfolio aren't showing up here. And it's not necessary that they're better banks. It's just they've had longer time to have done some gains before the panic.
Yeah, I think it's just a symptom, and I would lean on the sage words of Cy Lynch and say temporary or terminal ? I don't know, but I don't think we're looking at a terminal condition for either of these two banks. I don't think we're going to look at terminal conditions for a whole lot more banks, but that could happen to a few more. But when it's temporary, it's a buying opportunity. I mean, I had Western Alliance on my very short list for buying tonight.
Yep.
So, because it's also kind of fun to take an idea that you guys had that was a really good idea when I can buy it for 50% less than you did. But that's just me.
Yeah.
I will tell you, Mark, that one of our clubs that was one of the first clubs to move into Western Alliance met almost exactly 2 weeks ago. In fact, it was exactly 2 weeks ago today. And at that point, Western Alliance was trading in the mid-teens. And the club looked at it very carefully and looked at all the things we knew about it, went through some of our presentations, and finally decided to put more money into it. Now it's trading in the mid-30s, and we're quite happy with that. looking in retrospect, you wish you would have put 1,000 shares instead of 100 shares into it, but still 100 shares is better than nothing when it's gained $20 in 2 weeks. So.
Mm-hmm. Yeah,
I think
I guess.
need to, go ahead.
Go ahead.
Go on, Ann.
I just think we need to remember a long time ago when everyone thought that Hugh had lost his mind and wanted to buy Bank of America.
Absolutely.
And it went really, it did really well.
Nobody's conflicted with that. Nobody's going to argue with that either.
Oh, it's one of the all-time best performers.
Yep,
Yeah.
absolutely. So, folks,
all right,
do you think we should just leave our challenge stocks alone for this time and wait for the next, see what happens in 12 weeks, in 4 more weeks for the period?
Yeah, for my 2 cents, NVIDIA has such a high growth rate. I think we give it a lot of leash, like George Nicholson would tell us. And Regeneron, I think the pipeline is just fine. I think that, it's at 5% return forecast. Okay. But I think the pipeline's fine. Hugh, any comments on the Regeneron pipeline?
Regeneron has a good pipeline. I was going to talk about Regeneron. I was going to offer to talk about it next Tuesday at Bull Session.
Oh, cool.
Yeah, I was putting something together on Regeneron and on Immunogen, the one I'll chat about briefly later on.
That'd be great, folks. If you would like to hear something about Regeneron or Immunogen, and now we have another reason for you to come to Bull Session next Tuesday. Next Tuesday at 2:00. And if you need a link on how to sign in, an email to me or an email to Mark will get you a link for the Bull Session. So let's keep moving then, Mark. I'm going to turn it over to you to explain what this slide talks about.
Okay, this is just a real simple one. I am actually traveling. That's part of the reason for the audio challenge tonight. But this coming Saturday, a group of us are getting together in Tampa. If you're anywhere within driving distance of Tampa for Saturday morning, you're certainly invited to just kind of a breakfast jam session where we're going to just get down and dirty and talk some stocks. We'll get muddy and we'll watch the Rockets launch in Florida this coming Saturday. So that's just an FYI in case it's something that that you're in the zone for. All right. So with that, I think
we have 3 good questions, and before we start the stock presentations, they're all pretty easy answers. Okay. Len wants to know: does the total return that we're talking about include the dividend? Absolutely. Total return includes the yield that comes from the dividend on everything we're doing on the round table here. Cheryl wants to know, where can you go to find out the kind of things that banks are investing in and the way their loans are divided out? Cheryl, that would be part of any quarterly report or any annual report. Find the latest quarterly report, or better yet, find the last annual report. They will split those out many times in really nice graphs and show you exactly what where their loans are going and the kinds of loans that they're making and the kinds of investments that they have. I think I don't know this for certain, but I think that those kind of facts and figures are required as part of their SEC filings. And then Dan wants to know, how do you get the projected PE on these stocks? Mark, I'll give you that one. How do you get the projected PE values?
It's basically I'll give the nutshell answer, and perhaps we can go deeper at a future time. But it's basically a consensus. It's taking the value line projected PE and combining that with a couple other fair value based. We also have an imputed PE that we calculate based on the industry that a company is in. And we've talked about that a number of times at Manifest. Could probably dust that one off again also. But it's a consensus projected PE. Sometimes it is conditioned to more closely resemble the projected return on value. And that's also something we could demonstrate. But that's basically what it comes down to. It is a consensus-driven projected PE ratio in the future.
Okay, and we've covered those three questions, Mark. So let's get on to our first stock that we're going to take a look at then, okay?
Okay, this one was mine, but Cy stole it, so Cy has to go ahead.
All right.
So sorry, Mark. That's what happens, I guess, when you're on your way to Florida and your penance is I steal your stock since I am no longer in Florida. I had to leave last week, so.
I saw you had a good time.
Yes, I did. It was wonderful. I hope you have a great one too. As you can see, I'm doing Taiwan Semiconductor. We talked a little bit about banks being beaten up, and I was tempted to look in the banking sector. And another industry that right now is pretty beaten up and somewhat out of favor, I believe, for no real good reason, is the semiconductor industry. And we've been looking at various suppliers, MKSI and a few others, in that area. But of the suppliers, 2.6 is one as well. But Taiwan Semiconductors, the largest semiconductor, will look company, and we'll look a little bit detail at its business in a minute. And here you could see pretty up straight and parallel. Value line is reasonably optimistic. These are the current value line report is just about a week and a half old, but the stock is up a little in value. But the chart that you see there with the projected 18-month return and 3 to 5 year return, that is actually as of the price last Friday. So that's current information. Next slide. I did just a straight screen. You see the criteria there on the right. It's a pretty basic screen that I do, a little below the sweet spot. In this case, it was 17%. Just to see if there's anybody right on the cusp that might be interesting. Excellent quality, 80 and above. And given the current market, I'm comfortable relaxing financial strength to 70 just to let a few more companies in, although I don't mind 80 or better. And of course, you can see Taiwan Semiconductor is about as good in the quality metrics as you can get. 100 overall and in the 90s, high 90s, in fact, percentiles on the other quality metrics, a decent growth rate of 11.7%. And so I said, let's dig into this company. Next slide. Just a quick look at the industry. You see that there's a fair bit of potential opportunity here. I did look at Max Linear, but the earnings stability just gave me enough question that I said we'll pass on that tonight and go with a bit more established core type holding in Taiwan Semi. And you see that it has a very good return in the industry ranked by par. Next slide. And not surprisingly ranked by quality. It's right there at the top. And again, this kind of gives you some idea how the industry is a little bit all over the place because of some of the uncertainty. You have NVIDIA with almost as good a quality overall as Taiwan Semi, but next to no return. We've already talked about NVIDIA, and that's not because it's a bad company. The quality is good. The growth is good. It's just that its price has been driven up while many of these other companies have not. Next slide. Here's a quick 2-slide introduction to or refresher on what Taiwan Semi does. It's the world's first and largest dedicated chip foundry. There are microchip manufacturers, there are microchip developers. Many integrated chip makers do both. They develop chips and they manufacture them. Intel is an example of a very large one. Taiwan Semiconductor doesn't design chips. They only manufacture chips designed by other companies. Morningstar cites a survey that says in 2021 they had 57% of the market. Their factories are mostly in Taiwan, but their companies or customers range worldwide. Many of the U.S. chip makers use Taiwan Semi. You'll see that on the next slide. So go ahead and go. You see at the top, they have a wide variety of chips that they make. Most of their customers are what's called fabless. They solely design chips. They don't manufacture the chips. They do have some integrated competitor type manufacturers that also use Taiwan Semi. But you can see Apple, AMD, and by the way, AMD used to be a integrated manufacturer. They designed and made their chips. They now rely on Taiwan Semi to make all their chips. NVIDIA also uses Taiwan. Those are among their largest, best known, but there's many other as well. I believe this is a note from Morningstar, the chip maker, is that, again, chip makers are trending toward the fabless business model. We'll design our chips, but we won't make them. And so that gives advantages or tailwinds, as Morningstar put it, to Taiwan Semi because of its scale. And it's also a technology leader. I'll just mention briefly the most advanced chip manufacturing machinery. Apple wanted their chips made on it. Taiwan Semi was Apple's major manufacturer for Apple. Taiwan Semi about 5 years ago was somewhat reluctant to make the investment. So Apple said, okay, we'll make the investments for you, and funded the investment in these advanced chip manufacturing machinery and processes for Taiwan Semi so they could make the Apple chips. And now Taiwan Semi is way ahead of all of the other chip makers, fabless chip makers, or chip foundries, I'm sorry, the manufacturers, not the developers, because of that investment by Apple that Taiwan is doing. So they're the technology leader in the continuing trend to smaller and smaller, more powerful chips. Next slide. Here's just a quick overview of their last quarter revenue by technology. And again, you can see smaller and smaller chips. Main chunk of their business is in the 5 nanogram and 7 nanogram. Many manufacturers right now are just getting into the 10 nanogram. So they're well ahead of the power curve. Next slide. I thought I had another. Go back one slide. Did I skip a slide or miss? Okay, I must have left a slide out. There was one, I believe, by geography, but next slide. Oh, I take that back. I inserted this one in between the two. Very good. And you can just see that advantage in profitability. The black line, this is pre-tax profit on sales. And you can see that Taiwan Semi is well ahead of Broadcom, which is AVGO, which is another competitor, as well as the industry and the peer group. And that's largely because of that technology advantage that I mentioned. Next slide. Now we'll get to see the breakdown by not by geography, but by platform. You can see smart phones is a large chunk of their business. And you see significant growth in the automotive area for Taiwan Semi. Next slide. Here are the judgments that I did. I basically went with an 11% growth rate. That very honestly is below the average of a little over 15 for the last 5 years, if I remember correctly. It kind of matches well, it doesn't match last year's growth, which was much higher, but it just seemed to fit in my gut, quite honestly. It's slightly above Value Line's and Morningstar's. I think Value Line's projected growth is right around 10, Morningstar's right around 9 over the next 3 to 5 years. 5 years for Morningstar, 3 to 5 for Value Line. I believe Manifest is right around just slightly over the 11%. I use the 5-year average for profit margins. You can see Value Line is projecting a huge jump in profit margin, again, largely because of these smaller chips and the technology advantage. You'll see in 2022, the actual profit margin was 50.5. It does bounce around. So I said, I'll be content with the average and then take my pleasant surprises. And that gives me earnings per share of $9 roughly in 5 years. Next slide. And here we get to the return using a high PE of 27. There's a potential return of about 23.5%. And Mark just underlined it's got a nice yield, by the way, for a high growth company. 2% yield, even in this market, is pretty decent. And then an average PE of 18 still gives a solid potential rate of return of 15. And you could see that's compared with Manifest, which also has a little bit higher profitability, slightly higher growth than I was using. So again, 15% return I'd be very happy with, but you can see by the Manifest consensus potential of 18. I think Value Line, when this high is in the 23, 24 range, which again, my high PE would get us there. So I'm adding Taiwan Semi to the portfolio and saying, sorry to push you out, Mark.
Thank you, Cy. Yeah, the company Taiwan Semi is actually in the 10 Cup portfolio and a couple other places at Manifest, so it's kind of cool to see it there. All right, thank you, Cy. We will move on to Ann Manning. Again, for those who don't know, Ann is one of our former champions of our stock selection challenge a few years ago. That's what Ken was mentioning. And she's made a number of presentations here over the last couple of years. The other thing to know about Ann is she's got about a 70% hit rate. So if we want to raise our overall accuracy for the portfolio, guys, either we have to step up our game or invite Ann Manning more often. So Ann, take it away.
Yeah, I'm not up there with those guys all the way, okay? All right, so, all right, good evening, everyone. I have had Lamb Research on my radar screen for about a year now. I had some issues with the company that I needed to work through before I felt like I wanted to invest in it. And as I go through the presentation tonight, I'll tell you what my issues were and how I worked through them. Next slide. Those of you who heard me before, I like to know kind of the history of a company, and this gives you an overall view of the growth of the company and where they've gone to. David Lamb was the initial founder of the company, and he was more on the technology side, and he was smart enough to get other people to run the business side of it. Their IPO, as you can see, was in 1984. Nowadays, we think about chip production and semiconductors and all of that being in Asia. But I guess in 1985, the place to go was Europe, which kind of surprised me when I saw that. As you can see, over the years, they have indeed gone more to Asia for their offices and manufacturing. As of December, they had 19,200 employees. Next slide. This you can see a progression of their revenue over the year. I think it's pretty impressive how far they've come in, less than, I think it's about 40 years, but still in that industry, it had to build up. They have made these acquisitions, and you can see I made a typo. It's supposed to be Bullen Semiconductor. In 2012, when they acquired Novellus, they brought on a good many of their employees. In fact, today, one of the Novellus employees is the president and CEO of Lam Research, and another of the employees is the COO of it. I also wanted to show you the locations where they're located, particularly their manufacturing. Because of the ban on China, they are very lucky that they don't have any of their manufacturing in China right now. So this is a good thing for them. Yes, they do have offices in China, but they are so much located around the world that we're hoping that will not hurt them terribly. Next slide. My first issue with this company was I like to invest in something that I understand what they're doing. And I didn't really truly understand it. The top paragraph was the simplest thing I could find to say what they did. But for me, that didn't really tell me anything. So I kept reading. I read watched some YouTube videos, and the bottom part is the simplest way I can break it down as to what they do. They produce these silicone wafers that are used in chips and semiconductors. And their process is, they call it deposition, where they take a 12-inch silicone wafer and they take just slices of it off until they get it where it's just totally flawless. And then they go in and they strip it and clean it. And that may take numerous times to do that. And then once they get it to the point that they think it's clean, then they go in and etch it. And this, I wasn't sure what this meant. And this means that used to be when you had chips, they were connected to wires. And if anybody knows differently, please tell me I'm saying this, if I'm describing this wrong. But they had wires to go to the chips. One of the reasons that electronics are getting thinner and thinner is they no longer have wires. They have etched lines, and that's what takes the power between the chips. And so that's the etching process. And so then after that, they go through numerous stripping and cleaning again. And at the very last thing they do is they go over this disc and they make sure there's no defects. And this is all done within the equipment that they have. So that was my first issue. Next slide. I wanted to give you a perspective on how far we've come in the 40 years that this particular company has been open. There was 50,000 transistors in a single chip, and now there's millions in the single chip. Their wafer, which is 12 inches, has hundreds of thousands of chips. And your cell phone has the same computing power as 1 million PCs from the 80s, and your cell phone only has a small SIM card. So we've really, really come a long way. And what I consider a short amount of time, other people might not, but I do. Next slide. One thing that I like about this company is they are in the same economic issues as everyone else, same supply problems, but they're being very honest about what's happening with their business. As you can see, even though business operations may be down around the world for everybody, they still made $3.5 billion in cash from their operations in 2022. They're executing pretty well in the supply chain issues, and they know there's a weaker demand. They're working very hard to work around that so they can still be profitable. Next slide. Their customers are being very cautious right now, and before we tell Mark what company we're going to do, we don't know what other companies anybody else is doing tonight. Taiwan Semiconductors is a big customer of Lam Research, and so is Samsung. So they are all experiencing cutbacks, and this, of course, affects Lam Research. Of course, the China ban is not helping matters either. But I do like how honest they are being about all of this. Next slide. They are planning to reduce their workforce by 7%, which is about 1,300 people. They are going to try to reduce their overall spending, but their research and development is very important to them. So they're trying to preserve that. And they're trying across the board to improve all their systems so they are work more efficiently. Next slide. As you can see, their manufacturing capabilities are in India, Korea, and Malaysia. And they like that because it helps them to be closer to their bigger customers. You can see they have grown their installed base units significantly over the last 5 years from 56,000 to 84,000. And that's, of course, is, during the pandemic time, and they still were able to increase their base units. Next slide. As you can see, in 2022, their revenues went up from 16.5 billion to 19 billion, and their earnings per share went from 32.46 to 37.31. Next slide. This gives you an overall view of where their revenue comes from in reference to each segment of their business. And it also gives you by the region. And as we see, China is 24% of their revenue. They're still taking measures to offset that, and while the ban is in effect, and I believe they're, will be doing a good job to do that. Next slide. Okay, this is my SSG. As you can see, it is pretty up straight and parallel. I felt like if you see their last quarter, they had 24.9% sales growth and 27.6 on EPS. So I kind of tempered that back because of the China ban, and I felt like I wanted to be a little bit more conservative. So I went with a 13% growth in sales and earnings per share. If you will notice on the graph, analysts are projecting in 2024 that their sales and earnings will dip. But after that, they're predicting that they will go back up. And I don't have any reason to believe that they won't. If you'll go look on the right side, I want you to actually see the numbers that their historical sales have been and how much they have grown in the last 10 years. I find it really to be amazing how much they've grown. If you look on the percent debt to capital, this was my second issue with this company. You can see in the last 5 years, they've had some pretty big percentages of debt to capital. I personally don't like to see companies with more than 30%. The latest information I could find was that their debt to capital was 37.6%, which means it is going down. The other thing that helped me to have a better feeling about this company in terms of their debt was a term that I have just recently in the last few months become aware of. I learned through a niece that I have taught about stock investing, a term called interest coverage. I didn't know anything about this. If you go to Morningstar, if you have that available to you, you can find in their reports, it says interest coverage, and it will give you a number. And that number is the company's earnings before interest and taxes divided by its interest expense. If you can imagine, a company does not want to have a small amount of interest coverage. Just say if they had 1 or 2 years of they could only pay their interest and had a down time, that you can see where they would be in trouble. I was told yesterday that anything above 7% is considered good. So I felt really good when I went to Morningstar and Lamb Research number is 32. So that means they could pay their interest on just their earnings for 32 years. That made me feel a whole lot better. So as you see on the bottom of the form, normally for a company that has this consistency in their high and low PE, I would use the average PE for the high and low for the future. But again, we are expecting some downturn in what they have. So I put my high PE down to 17. I felt that was more reasonable than the 20, which brought my high price to 1165.20. Now you'll see that my low price that I projected was 401.10. That is a personal preference of mine. I always put my low price at 20% below the current price. Now the current price that you see there of 501 was last Friday when I turned this in. Today it closed at 485.08. So it has gone down some. Now, some of you may be more comfortable doing the recent severe low price, and that would be okay too. I can see where someone want to do that. You would still be in the buy range if you put it at 292.30. So that, I think it's just a personal preference. Next slide. This is my final results at the top. Projected average return was 15.6. If you will look at the manifest page, you will see that I was not far off. I'm a little bit higher than their par. You will see that Lamb Research has great quality. Their sales growth is at 12.2. And which is really interesting because most of the time when I do SSGs, I tend to do a lower sales growth than Manifest does. But for some reason this time, my projections were a little bit higher at 13. My high price is actually just a little bit above their projected average price. So I really felt like I was in the ballpark for this. So that's my suggestion for the night. I know you may not feel comfortable with this stock because we are projecting it to go down, but I would suggest you definitely put it on your watch list because I think this is a very good company. Thank you very much.
Very good. Thank you, Ann. Yeah, and let the chip duel begin. All right, so our little educational segment tonight is going to be Ken giving us a refresher on the triple play because we're certainly in that mode mentioned at the bottom of the slide. Go ahead, Ken.
Yeah, Nicholson talked about at the end of a bear market, especially a long bear market, that you should be looking for triple plays, not because they were the greatest investment possible, but because they might be one of the best ideas possible. He didn't guarantee that a triple play was an automatic buy, but he did say that being a triple play deserved moving that stock from the bottom of a wish list to maybe the middle or the top of the wish list. To Nicholson, and he wrote it in this investor's manual. This is a direct quote from the manual. Nicholson said, look for a depressed price of the stock, look for increased profit margins, and look for the increased profitability of the company that might come when the PE ratio expands. So again, a depressed stock price, the chance to increase profit margins, and PE expansion. Let's see where that takes us. Next slide. On March 24th, that was just a few days ago, Value Line showed a median appreciation potential 3 to 5 years from now of 70%. That's right on the front of the old paper Value Line that gets delivered in your mail. That issue had an appreciation of 70%. If you work that out yearly, that's 14.2% for 4 years, or if they're talking 5 years, that's 11.2%. I would figure with my par being 12.4, I would figure that a depressed stock price would have a par somewhere in the 16, 17, 18% range or more. A depressed stock price would give you a higher par. Keep that in mind. Next slide. I would then look at profit margins. I can find that right on a value line sheet. There's actually a line in the grid that says net profit margin percent, and I can see what the actual profit margin was in the last fiscal year. I can see value lines call for the current profit margin, and I can see value lines estimate 3 to 5 years in the future. If I see the estimate larger than perhaps the call for this year, that's number 2 in the triple play, a potential for an increased profit margin. One more slide, Mark. And then I can look at the PE if it's a current value line report, and up in the top in the middle is a value that I can use as an approximate current PE, and I can compare that to where value line thinks the PE might be 3 to 5 years into the future. In this very old example, you'll see Stryker was trading at 13 and the average was thought to be able to move to perhaps 23. That's definitely PE expansion. Let's look at my company, and my company is Avnet. I'm looking first of all over on the left-hand side. I'm looking at the 2026 to 28 projections, and I'm certainly seeing numbers that lead me to believe that the current price might be depressed. I'm then moving to that box down near the bottom of the grid. I've boxed in the net profit margin. The most recent fiscal year profit margin was 2.8. For this fiscal year, the call from value line is to move down to 2.6. But notice out 3 to 5 years, value line is calling for 2.9. Second leg of the triple play, it got larger. Third leg, check that PE ratio, around 6 or so on average up at the top. Compare that to where value line thinks it might be 3 to 5 years from now, 11. I have a triple play. So I moved this to the top of my study list. This value line, by the way, is very recent, coming from March 24th, 2023. And I discovered the name Avnet. It was not a familiar name to me. I discovered it by using the Manifest Investing Screener that allows me to screen for triple play candidates. Next slide. So here's Avnet. It closed a couple days ago at $43 and change. It's in the middle of its fiscal year right now. It has an odd fiscal year. It doesn't match the calendar. And the industry is electronics and computer distribution. And I would guess if you would read the description, you would not have a particularly good idea of what the company did. So I'm going to try to explain to you what the company does. Next slide. In the 20s, the 1920s, when Avnet was first formed, it was a company that dealt in parts that you would put inside of a radio. And I don't mean a transistor radio. I mean the kind of radio that I grew up with, where my mom listened to the Many Lives of Helen Trent and all of the rest of the soap operas. And when something went wrong, you pulled out a lot of stuff from inside the radio and you brought it to the drugstore and you tested some of the vacuum tubes in it. In the 50s, Avnet, moving with technology, began to de-emphasize radio parts and emphasize electrical components, switches, fasteners, microprocessors. In the 80s, they began to understand that if they could help a customer that wanted to manufacture something, if they could help that customer by providing them with all of the different doohickeys and widgets and gizmos that you needed to make whatever the product was, and then get it to that customer in the right time for manufacturing, if they could help them streamline the design and in the process match some of Avnet's products, and if they could do this on a global basis, they might succeed as a company into their next century. And in the present day, that's exactly what they're doing. They're manufacturing all kinds of components, all kinds of things, and they're doing a lot of specialty work for companies. But their biggest job right now is talking to a company, finding out what it is the company wants to make, and then helping them design it, helping them make it using as much of the content as they can coming from Avnet itself, and then putting the company in contact with other suppliers and organizing a supply chain that will get all those materials to the other manufacturer in time for them to produce that product and sell it and make a profit. They can design local and they can build it anywhere. Notice they have 13 distribution centers worldwide, 25 third-party logistical centers, 300 secondary facilities. They're helping customers all over the world. They put their business into two different components. Next slide, Mark. Their business is 92% components, and that includes all the supply chain help and all the design help and all of the other kinds of things that you can do to sell those components. And it's 8%, and they call it Farnell. And Farnell is selling to other people the tools to make the tools that help design the components. So Farnell is kind of a back room when your widget wears out, and that widget is used to make thousands of other widgets. Farnell steps in and helps you with it. You can see their business distribution, a quarter in the Americas, a little bit less than half in Asia Pacific, and Europe and the Middle East and Africa about a third. And their products, a lot of semiconductors. That's the theme for this evening, I think, semiconductors, but a little bit with computers and a little bit in a category that they call IP&E, which is a little bit of a catch-all category. Think of it as not semiconductors. IP stands for industrial production and engineering. Okay, next slide. Revenues in quarters, very strong, and they've been getting stronger as companies discover that Avnet not only sells you these little components, but will help you design your supply chain, and then will help you assure that your supply chain doesn't go belly up. That's become extremely important to a lot of medium-sized and smaller companies in the last couple years when they found out that they could not rely on supply chains the way they thought they were able to. Next slide, please. Revenues, you can see what revenues are doing. I'm just picking out a couple of words from the slide. Nearly 56% of Farnell sales, that's like tools, and 72% of all the other orders come through e-commerce. So they've rapidly moved from a model that used persons to go out and pound the pavement and make business. They've moved to an e-commerce platform. I think the COVID idea kind of pushed them into this direction, and they've discovered that it's even more profitable than what they were doing prior to the pandemic. Next slide. Here's my numbers. I wasn't able to find a lot of companies that follow Avnet, but ValueLine does have a regular page on Avnet, and ValueLine suggests that earnings might grow at 22% and sales might grow at 9% 3 to 5 years into the future. Notice the projections. I've shown you that before. Notice what Manifest is saying. Manifest is giving me a par just under 20, and it's suggesting that sales might grow at 6.5%. Well, that was my first hold it moment in studying the stock. How can Manifest and ValueLine be so far apart? I have a feeling some of it has to do with where they start the projection from. And so I'm going to try to stay as close to the low number as I can. And then if things work out so that my numbers are very low, the surprise should be good rather than bad. Next slide. Here we go. COVID was terrible for the company, and you can practically remove 2020 from the graph as an outlier, but you can see that the company came roaring back after the pandemic. Sales also picked up from the pandemic moving forward, and the last quarter was really robust. I'm suggesting that sales are going to grow at 6%. Now, folks, that might seem really, really conservative, but this is a large company, and large company only really expect sales to grow at the 6, 7, 8%. So I am putting in a conservative number, but I don't think it's extremely conservative. Every single source I found, and I told you I only found a couple of sources, suggested that earnings were going to grow more quickly than sales. So I let my earnings grow more quickly, but not much more quickly. I let them grow at 7%. Next slide. Here's where I was able to do things with this SSG that I haven't been able to do, and I can't count the number of years. I'm using an average high PE of 10, and I'm using an average low PE of 3. When's the last time you used PEs at that level? My SSG, using the growth that I showed you on the front, and using these PE values, and using a payout, which I will show you in just a moment, gave me a par value of 18.9%. Remember, Manifest had suggested 19.5. I think I'm pretty well on with what's going on. The payout ratio is 35.8. Next slide, Mark. And that 30, whoops, I forgot to capture one slide. Go back if you want to. And that that payout ratio of 35.8 is showing a dividend that in today's price is about 5%. And going forward, it should be about 2.5% at the high side and about 2.3% at the average side. This is a good dividend payer. It's paid a dividend for a significant amount of time. The company is well over 100 years old, And we're looking right now to have a number at around 18%. I'm going to close by telling you that the last paragraph in the value line starts out, you should all have this stock in your portfolio. If you don't believe that, I suggest you go to the value line and take a look at the last paragraph, the first sentence. Thank you.
And now we do at the roundtable.
We will, yes.
All right, we are running a little bit long, but Hugh, if you want to go through and give us a quick update on Immunogen, we'd certainly appreciate it. Hugh presented this at the COVID cancellation conference back in 2020. So let's see what's on his mind at this time.
Sure. Yeah, I'll go through this, and then another teaser for next Tuesday. I'll go through Immunogen in a little bit more detail. Next Tuesday morning, I think it's 11 o'clock, Tuesday afternoon your time. It's morning my time here in California. Right. Sorry for the chorus of dogs in the background, but they are biotech investors too. So Immunogen, it's a 40-plus-year-old company, which is really old in the biotech space, and it literally is a biotech company. Its focus is on things called antibody-drug conjugates. So it uses the targeting power of antibodies, things that your body produces. They're highly specific. So your body will produce an antibody to target a specific invader, type of flu virus, cold virus, a bacterium, a virus, something like that. And once it has tuned in the right antibody, it produces millions of them to attack and destroy it. It's one of the reasons it often takes you a few days to get up and running or get fixed after a cold, because it takes 2 or 3 days for the body's immune response to really kick in hard, for your white blood cells, your B cells, to produce enough antibodies to attack the invader, and then it continues the attack for days after that. So the cold or a flu often has a little bit of a tail on it. But once it has produced an antibody for a specific invader, it tends to remember that for a very long time, hopefully for your entire life in many instances. And so if another invader comes along that's the same, the body is immediately ready to respond and destroy it. About 40 years ago, they had the idea, well, listen, if we've got these molecules that are highly specific and will target one thing in the body and nothing else, we could attach a highly poisonous small molecule to it, and the antibody could dump the small molecule into the cell that we want to target, and it will destroy that cell and nothing else. And so this has been the promise for the last 40 years. This is the generic type of antibody. It's a kind of a T-shape, if you will, but all antibodies kind of look the same. But very often there's a linker and a cytotoxic drug that's added to this antibody and sent on its merry way to find the cell. In some cases, it might be a cancer cell, could be an invading cell that causes inflammation, could be an invading cell that's a virus. But generally, because these drugs are very expensive to produce, all of the research right now is in cancer for antibody drug conjugates. It's an antibody and it's a drug, and they're conjugated or joined together. And it took many, many years for this linker technology to get optimized so that it wouldn't dump the toxic load into the wrong cell. It took a long time to figure out what the correct number of cytotoxic molecules attached to an antibody should be. That's the antibody to drug ratio. And that's about 5 or 6 now, but now it's really optimal. And it took a long time to figure out how to get it through the cell wall so that the cytotoxic agent can get to the point in the cell that it needs to get to do its destruction. Because the joke is that there are molecules that can destroy cancer or any kind of an invader. Sulfuric acid will do it, hydrochloric acid. We've loads of bleach will do it. The trouble is that they're not really pharmaceutical molecules because they will destroy everything else that they touch as well. But this might be a way of getting something that's highly cytotoxic. By cytotoxic, you mean that it's harmful in this case to cancer, but it can actually trigger cancers as well if it gets to the wrong cell. And in very small amounts, we're talking about billionths of 1 particle per billion molecules, very tiny concentrations of these molecules are lethal to the body. So you want to make sure that you're delivering it to the point of pain and nowhere else. And antibodies are primed to do that. Antibody drug conjugates have taken off in the last 2 or 3 years. Almost every pharmaceutical company worth its salt, major pharmaceutical company, now has research programs in antibody drug conjugates. There were only 5 approved drugs even 3 and 4 years ago. That has more than doubled in the last number of years. The pipelines in pharmaceutical companies have just exploded with ADCs, because the beauty is once you have a cytotoxic molecule that does its work, all you need to do is to change the antibody and you can send it after different targets. Now, Immunogen had a bit of a problem a few years ago with their, you can see the first molecule up here, where the IMAB is the monoclonal antibody, and the molecule on the right is the cytotoxic agent. And the problem was with their clinical trial is that they did not screen people inappropriately. And they ended up screening people that should not have been in there. That diluted the results, and it didn't show efficacy. When they went and did what's called a retrospective analysis of the trial, and they only selected those patients that really should have been in the trial, that had the problem and that were receptive to the drug, and this should have been very clear at the start, but they used the wrong statistics to include people in the trial. It was clear this drug was highly successful. But the FDA doesn't allow you to do retrospective analyses. What it tells you to do, if you have a drug that you think works, and they may even agree that it works, and in this case they have put it on fast track, they say you have to run the clinical trial all over again. You have to state at the start what you're trying to accomplish and how you want to accomplish it, and then you have to demonstrate to us that you've reached the goal, that you've reached the target goal that you've set at the start. If you do that, then we can perhaps approve it. If you don't do that, then we tell you, go back to the drawing board and start over. Well, they had to go back to the drawing board and start over. They refined the patient population. They've run the clinical trial again. They will release results in a few weeks, the second quarter of this year. So maybe a month and a half from now. I can't remember the specific date, but it looks highly promising. This stock price is a little bit old, but the point is that we're now back on, I think it's $2.66 a share. We're back where we were, or $3.66. We're back where we were 2 or 3 years ago. So now in full disclosure, I've added more to my portfolio. And I think this drug will be approved at the end of the year. We get the clinical results in about 3 to 6 weeks. They will file with the FDA for accelerated approval. That should be granted by December, and then they will have another drug in the pipeline. So I'm very hopeful for this company. I do think it's going to be acquired. The other company that was formed around the same time, Seattle Genetics, which changed its name to Seagen about 3 or 4 years ago, that was recently acquired for $40 billion. The market cap of this company is about 800 million, so I don't expect it to be a 40xer, but I do think it could be a 5 or 10xer in the next year or two. And because of the amount of technology that it has in its portfolio, I would expect this company to be acquired.
Unmuted.
Particularly since there's a huge hunger for antibody drug conjugates right now among major pharma. So that is my, and there I talk about in delaying the program for 2 years because of an error. That is my short and sweet presentation and a little bit of teaser. Like have a little beer here for next Tuesday.
Okay, thank you, Hugh. That's fascinating to go back and look at what we've been watching the progress that they've been making over the last few years. And Ken, this might be my next Ardelic.
Yes.
What is the name of the drug, Mark?
Immunogen. What's the actual name of the drug?
Kachingadol.
Chinadol. Okay.
Mirasol is the one that they're going to try to get approved at the end of the year.
Okay, great.
Cool. Thank you, Hugh. All right, I'll do the 2-minute drill here. Basically, as I'm looking for companies for this particular roundtable, there are a few that popped up. Dollar General was featured in a nasty article in Barron's this past weekend. Full disclosure, one of the members of our board of directors at Better Investing is an executive with Dollar General, so we take it kind of personal. But as I read the story, it's actually kind of trivial what they're complaining about relative to the size of the company. And as Hugh McManus has taught us, anytime there's loathing going on and piling on, you might want to search for an investment opportunity. I did not choose Dollar General tonight, but I was tempted to buy the dip. Same type of concept with the banks and the crap we were talking about a few minutes ago. One of these days I'm going to go back and look at a Wells Fargo back in 1991 specifically and make some comparisons to some of the stuff going on now and see if I can't identify a Wells Fargo-like opportunity, because I'd certainly like to have bought Wells Fargo for under $1 back in 1991. So that's, again, that type of thinking. So I just leaned on the top 100 companies by manifest rank, again, best with respect to return forecast and quality in our universe. And lo and behold, Taiwan Semi comes up at the top of the list. Avnet is on here. I'm surprised that Lam didn't make it too, because it's really close to this list also. But I did want to go with one of the banks. The banks are all just getting beat to death. And one of the companies in our portfolios, it's actually in our best small companies this year, and it's in the 10 Cup portfolio, is Service First, which is a regional bank out of Alabama, and probably one of the friendliest banks in the country. And that's all I need to know. They're not doing all the crazy stuff. It's a diversified bank. We'll go a little bit deeper, but it's selling at a relative strength index of down around 30, meaning it could be on sale. And even with recessionary conditions, it's projected to actually go up. A lot of good companies on this list to study, but we're going to go with these guys. Again, they've come back from high 90s to low 50s, and they're basically trading at a relative strength index that they have not seen in the last 10 years. Here's the other thing that we look at anytime we're looking at a bank, insisting on a quality, high return on assets. You can see that these guys are not a flash in the pan. They've been operating above 1.5. We know that 1.2, 1.25 is good. 1.7 is better than good, and they are doing it. Their book value, basically the value of the company over time, pretty much a straight line, at least half of up straight and parallel. So here's what you're looking at. A company trading at a book value of approximately $24, growing at 15%, call it 14, call it 16, I don't care. That looks pretty good. They have a projected ROE in the mid-teens. That's also very defensible. I know that Ken owns this one, and I can see why. A projected ROE of 17, a PE ratio somewhere in the 16 range. Again, very fairly ordinary. And again, a very nice projected annual return. This is not a sexy, out of this world bank. It's a down-to-earth bank, and it's getting punished. Not quite as much. It's not going to be quite as sexy. It's not going to be quite as frisky, but it's a good long-term investment. So with that, Ken, I think we can go to the poll.
Okay, give me just 1 second here, Mark. And here's our poll, folks. We put Dollar General in there just because I didn't have time to take it out. So just
what are we going to do if it wins?
If it wins, we'll buy one of them, okay?
Okay.
We'd love to have about 80 or 90% of you voting. Doesn't cost you anything. Only takes a little bit of effort to move your cursor over there and pick one, or if you have a touch screen, you can just point to it and it works. We're up to 70% voting. I'm going to give you another 10 or 12 seconds to make a decision here. You're not in a voting booth, folks. This is not for the next 4 years. This is just adding a stock to a non-money portfolio. We're at 85, 83% voting. I'm going to kind of count in my mind to 10 here and see if we can push it up a couple more. And I did. I pushed it up a couple more, and we're going to close it now. And we're going to share the results. And
oh my.
We're going to put an extra $1,000 in Taiwan Semi and an extra $1,000 in Avnet. If that's okay with everybody.
That is okay, but you are aware that you can be indicted for begging for votes.
I didn't beg for any votes. You were the one begging for votes.
I'm just kidding. Just kidding.
So,
It was a bipartisan comment.
all right.
Bipartisan.
And I'm just glad I got more than Mark did.
Yeah, well, notice
Oh.
Mark only got 17% if you add together both his stock picks. He tried to.
Yeah, he tied you, Ann. If you,
Yeah.
I know.
But it took,
Fair,
but it
I'm
took,
fair.
but it
Okay.
took him to 2 stocks, Ann, to get that.
we've
so.
played
Right.
we've played enough games here. Mark, do we have any closing comments here?
Just that you guys all cut me deep. So you cut me deep. No, just a quick reminder that we will archive this session along with all the other sessions we do at Roundtable and the Bull sessions at YouTube. Just search on Manifest Investing. You could put Roundtable in there. You will find it. We would love if you would subscribe, and we'll let you know anytime we add a future session. I would point out that our more recent session back on March 14th, where Ross Meredith and Matt Spielman commented on Silicon Valley and the bank fiasco, is getting a lot of page views. A lot of people are checking in on that session, and I'm told that the bank part of it starts at 27 minutes if you want to fast forward. So that is out there. We do have some things going on in weeks ahead. I will be in Tampa on Saturday morning, as we talked about previously. If you want more information on that, send me an email. Our April roundtable is approximately 4 weeks out. And Ken and I will be in Cincinnati on the 29th. We will be talking more about the things we will be doing in association with the e-convention for Better Investing this year in early June. And then we do have some other appearances around the country that we will be embellishing on at future dates. Anything you want to add to that, sir?
No.
Just one?
Go on.
Go
Si.
ahead, Tim.
No, go on. Si.
All right. I was just going to say, if you can't make it to Cincinnati, but you're near a computer on April 29th, I'm doing an online seminar for the Central Indiana chapter. So you can go to their BI website and get information on that.
I'll post some information on that on Manifest Tuesday.
Yeah. Okay. Yeah, that's on, and I think I'm going to be talking about portfolio management in some pretty broad terms. So
I think we should also say, Mark, that the April Roundtable will be co-sponsored by not only Manifest Investing in the Mid-Michigan chapter, but it'll also be co-sponsored by the St. Louis chapter of Better Investing. We'll be having a class before the Roundtable, and then we'll move into the regular Roundtable program. Our note that goes out to remind you to register will explain how you can go to one or the other or both of the events. And we'll have some of the St. Louis people helping us out, and we'll have representation from one of the damsels in St. Louis. Give me a help on the name, Mark.
Oh, Candace Baker. Candace is a gem.
Baker, of course. Candace is going to help us with a stock presentation on the April Roundtable. We will stick around for a little bit after we close this down officially to answer some questions. So if nobody has anything else, thank you so much for coming. We hope we see a lot of you at Tuesday's Bull session. And I'm going to stop the recording.